Okay, good morning and welcome back everyone to our Tuesday morning market outlook session. My name is Tony Zhang. I'm the chief strategist here at Options Play, and I apologize for the few minute delay in terms of our start. I just had a bit of technical difficulty on my end, but just a quick review of where we currently stand here in terms of equity markets. Oops, sorry. So a quick review of where we currently stand here in terms of equity markets. Last week, we saw a little bit of volatility here last week with regards to the S&P 500 essentially notching new record highs at the beginning of the week. And with the surprise inflation print that we saw here last week, that was when things started to shift a little bit in terms of expectations. Largely at the beginning of last week, we were expecting 3 rate cuts from the Federal Reserve, which was quite supportive of equities, and we had a pretty strong, I would say, bullishness here to the market to start off last week. But that surprise inflation print that we saw here at the end of last week really shifted the probabilities of what the market expects from the Federal Reserve between now and the end of the year. The surprise inflation largely shifted expectations from 3 rate cuts for 2025 down to 2. And last week we saw small caps outperform, value specifically, value small caps outperform large cap growth, which was a bit of a shift here in terms of expectations here from the markets. And we see the VIX continue to hover just around that 15%. Volatility at the moment remains fairly muted. And markets largely still remained on the offense, even though we started to see the start of some more defensive positioning here at the end of last week, with largely healthcare and materials actually outperforming last week, while tech really took a bit of a back seat. And we saw interest rate sensitive sectors like home builders outperform in this particular market. So that's kind of where we stood starting off this week. This particular week, really the big headline, if you will, is Jackson Hole. What we expect to hear from Chairman Powell at Jackson Hole with regards to his views on inflation, on the labor market. I largely expect the tone to be very similar in terms of expectations for what Chairman Powell will be telling us. Opening the possibility of rate cuts here this year, but still remaining, as he calls it, data dependent. We have at least one more inflation print and one more labor market reading before that September meeting. So I don't believe that we're going to get a definitive answer from Chairman Powell this week as to whether or not they will be cutting rates in September or not, because that data that he's looking for would be part of the decision-making process. So that's kind of where we currently stand in terms of earnings season. We're very much at the tail end of earnings season, but this is a big week for retail earnings. We have Walmart, Home Depot, Target, Lowe's, the big box retailers are all reporting this week. And that largely would kind of close out the earnings season from the S&P 500 perspective. There's still going to be a few more reports coming up in the next few weeks. They're going to be far more far in between those big names coming up here in the next few weeks. So that's currently where we stand here from a equity markets perspective. As you can see, we continue to make higher highs on the S&P 500. You see that here for both the S&P 500 as well as the NASDAQ 100. So when we look at the Nasdaq 100, we basically saw last week, at the end of last week, we made a higher high. We pulled back a little bit here, but largely, as you can see, the bullish trend that we have been in remains intact here for both S&P 500 um, and the Nasdaq 100. Where we saw a fair amount of outperformance here last week were in the small caps. As you can see, Russell 2000 made a bit of progress here last week. We're still below the 52-week highs of 242, but that's our upside target here right now here for small caps. As you can see, trends while turned a little bit neutral here for a couple of weeks, has remained positive here, and the breakout here above 225 is constructive for a further upside move here in small caps to that all-time high. We also have equal weight S&P 500, the RSP equal weight S&P 500 ETF. Very close to all-time highs here. That's still our upside target, is to make new all-time highs. And that really shows us that participation on this rally has been broadening out. If you look at the percentage of stocks trading above their 200-day moving average on the S&P and the Nasdaq have continued to improve. And they're in a range that I would say is fairly healthy for equity markets to be at all-time highs, while still at the same time giving the equity markets some further room to go based on where market breadth is right now. So overall, when you look at kind of equities, things still look fairly positive here across the board. One thing that is starting to turn a little bit further south here are our bonds, and we'll continue to monitor that here. As you can see, the bond markets have started to turn a little bit further south. That has sent bond yields a little bit higher here in the last week or so. So we'll continue to monitor that because that is moving in the opposite direction of what we're expecting here in the second half of the year. But like I said, those probabilities of how many rate cuts we're expecting for the second half of this year have shifted quite a bit here over the last 3 to 4 weeks. But it's clear that the bond markets are pricing in a slightly higher yield here than compared to a week ago on, let's say, the 10-year. So with that in mind, let's take a look at some of our ideas here for the week. As I was showing you here before, we're seeing some of that outperformance from some more defensive sectors. So Danaher, DHR, medical device provider. This is one that we've been looking at here, potentially as a bit of a turnaround story. As you can see, the stock has kind of spent the better part of this year trying to form this big bottoming formation, and we just saw a bit of a breakout here last week. We're looking for a retest, potentially a continuation higher here for DHR. And DHR, from a valuation perspective, I would say is not undervalued, but I would say it's fairly valued. It's trading at 27 times forward earnings, which is a premium to the industry average, which is closer to around 18, 19 times forward earnings. But if you look at growth expectations, they've largely come in line with the industry. But where it exceeds the industry is in net margins, specifically how profitable and how much free cash flow DHR generates relative to its peers. It is quite a bit ahead of its peers. It outperforms nearly 90% of its peers from a profitability perspective. And that is what justifies the premium valuation that DHR currently trades at. And we're looking to see if the charts also agree by starting to break out here from the current trading range and continuing to trade higher from here. One that we talked about here last week that is in the same vein is BDX, Benedict Dixon, Becton Dixon, another medical device equipment manufacturer. Very similar price action here that we saw here in DHR. As you can see, the recent breakout here above this 185 resistance level here, that was the bottoming formation that we saw. Since that breakout here, the stock has continued to move higher here. Our short-term upside target is 202, but our longer-term upside target is closer to 245, which puts us all the way up here. Now, BDX trades at a pretty substantial discount to its peers. It's around 13 times forward earnings, even though it's expected to grow a little bit slower than the industry. Um, and it's not as profitable as its industry, but that's really where the valuation comes in. It's trading at a very heavy discount to its industry average. It's trading at only 13 times forward earnings. So with those types of valuations, yes, it doesn't grow as fast and it's not as profitable, but from my perspective, there's still a fair amount of potential upside here in the stock, given how low the valuation is trading at the moment. And I think the breakout here from a price action perspective reflects the market taking advantage of that lower valuation at the moment. Next one to take a look at here is Lowe's, which reports this week in terms of earnings. And we've been looking at Lowe's since it kind of broke out here above this 235 resistance level, right? So similar to some of the other chart setups we've been looking at, the stock bottomed here for the first half of this year. Earlier, about a couple of weeks ago, the stock started to break out here and it's really started to take off here since it's broken out. It reports earnings here this week. Our upside target is here is 265. That would be the effectively the 2025 highs to get back to those 2025s. And we're looking at earnings potentially being the catalyst that could drive this stock back to the year's all-time highs. And I specifically like Lowe's over Home Depot, both that are reporting here this week, and both obviously are in the home construction retail space, is due to valuations. Lowe's trades at around 20 times forward earnings. Home Depot trades at around 25, 26 times forward earnings. Growth expectations for Lowe's is basically in line with the industry, but where it excels is in profitability. Lowe's is more profitable than about 70% of its peers, with net margins that are north of 8%, which is pretty strong here for a big box retailer. Think about Walmart, Costco, Target. These are companies that operate on 2, 3, sometimes as maybe 4% net margins. Lowe's at 8% is sitting in a much more comfortable position here strategically. So that's really where, trading at 20 times forward earnings, I think is more than reasonable. And if you look at Lowe's, their recent relaunch of their loyalty program is focused on trying to capture the pro market. And that is what Home Depot has the majority business in, but Lowe's is making some progress in stealing that share of the market, and I think we're starting to see some early signs of that, and that is part of why the stock has taken off here in the last couple of weeks, and investors are starting to pay attention after spending the better part of this year effectively just treading water and treading sideways. Another one I want to take a look at here is Amazon. Now, We basically took advantage of the sell-off here in Amazon to look for a bit of a bounce back. We're looking for a continuation back towards all-time highs at 242. That's our initial upside target here, but we are looking for going to beyond that, around 260 here to the upside. And Amazon, like many other big box tech names, I would say is at a valuation that is at the very least fairly valued, and some could argue potentially slightly overvalued. But Amazon growth expectations are quite strong. We're looking at EPS growth that's around 18%, revenue growth around 11%, so far outpacing the average S&P 500 stock. And also on profitability, we're looking at around 11% net margins, which is quite strong here again for a e-commerce site. Given obviously Amazon operates their web services, and what's interesting about Amazon is that they are producing their own AI um, workload semiconductors, which is going to put them potentially at an efficiency advantage relative to its peers, who most of them are not venturing into the semiconductor space and have to rely on third-party suppliers like NVIDIA and AMD to supply the chips that they need in order to build out the data centers and support the customer growth that they expect to have from the use of AI over the next few years. And I think this is really something that is going to come to a head here, if not soon, relatively soon, with regards to just how much capital the big tech firms are spending to innovate and grow their leadership within AI, and where the market realistically is in terms of generating revenue from AI. I think investors uh, sometimes can be a little bit optimistic with regards to new technologies and pay strong valuations without necessarily thinking through, is there enough revenue or earnings on the back end of this to justify the valuations that we're trading at. And I think Amazon is one worth examining, but at the same time I think represents upside opportunity to this particular industry or the growth of the AI industry. Um, Within kind of tech, Alphabet is one that I think is also worth paying attention to here right now. And Alphabet, as you can see, we basically went long on the pullback here on Alphabet here, and the stock has rallied substantially since we've entered this bullish position here. And we're basically now back to all-time highs. Just at the end of last week, we saw Alphabet notch a new record high. And the question is whether we break out here above that 206 double top level and continue moving on. If we do, that's a pretty bullish signal here for Alphabet. And if you look at kind of if you kind of look at the stock here, it's trading around 20 times forward earnings, which is essentially in line with the industry. Growth expectations are in line with the industry, but where Alphabet really excels is how profitable they are. And I think for those reasons, it is by far the only Magnificent Seven tech stock that's trading at a valuation that's in the low 20s. Almost every other AI related hardware, software stock is generally trading at 30, 35, many of them approaching 40 times forward earnings. And like I was saying, as I was saying before, I think investors need to potentially brace for any corrections in that particular valuation that we've been assigning here to these specific names based on AI, based on other factors that have contributed them to trade at multiples that historically speaking are extremely expensive. So those are some of the things I think we have to be very cautious of as we look for opportunities. And my preference is to be more patient and seek the right opportunities when they come along. And then looking at some of the ideas here for the week on the bearish side. Um, so Philip Morris is one that we recently added, tobacco stock. And Philip Morris, if you look at the chart here, uh, as you can see, it broke down below that 175 level here, broke down, started to come back to retest this level as resistance, and we're looking for potentially further downside here because the stock trades at a valuation that's quite rich, 22 times forward earnings. Growth expectations are a little bit higher than the industry, but where Philip Morris has really struggled here in the last few years is on profitability. We continue to see margin compression here for tobacco stocks, specifically Philip Morris, and that has led to a pretty significant shareholder or a significant decline here in terms um, of the stock and kind of that breakdown below 175, and now the retest of that level suggests that there's potentially some further downside in store. So that's why we, at the moment, even though equity markets look quite strong, are taking a few bearish positions here in the market. Cintas, this is a uniform company. They provide uniforms for workers. As you can see, this is a stock that also recently uh, kind of struggled a little bit here at this 225 level here, and we were looking for a continuation down to the 200 level. That's our downside target. And this is starting to play out nicely here over the last couple of days here for this particular stock. Cintas trades at around 45 times forward earnings, which is not a joke. It is literally a uniform company trading at a valuation that's more expensive than Nvidia and Oracle and any of the major tech names. Um, and we've just, um, and with a softening labor market, I think this is really where, uh, uniforms and specifically the relatively high valuation that it trades at is a risk to this particular stock, and that downside risk, in my opinion, targets around that $200 level here to the downside. And then I'll leave you with one more idea here for the week, which is CrowdStrike. And CrowdStrike within software SaaS is by far one of the most expensive stocks from a valuation perspective. We basically were looking at this kind of breakdown below 475 as a reason to potentially get short. I retest that level as resistance and continue to move lower here. Our downside target here for CrowdStrike is 420, and we're just within spitting distance of actually reaching that target price. But there's really very few stocks trading in the same realm as CrowdStrike in terms of valuations. Really, Tesla is the only thing that comes close because we're trading around 120 times forward earnings. Um, it, there's just really not much to say other than this stock is very expensive. It's expensive both on an earnings basis, it's expensive on a revenue basis. It's trading at around 25 times revenue, which is almost unheard of. This is not just the fast-growing startup that it used to be, that it once was. It's the growth has slowed down a little bit. They've had to mature overall, and that is something that I think they need to revisit with regards to their valuations, because the company is not profitable. The fact that it doesn't turn a profit and still commands such rich valuations is where I have some concerns about the downside risks of continuing to hold a stock like CrowdStrike. So with that, that covers what I wanted to share with you here today. I hope that this gives you a good understanding of kind of where we stand from a macro perspective, and the fact that the equity markets remain fairly resilient. The bond market so far still pricing in a relative calm going forward, and hopefully shared with you some of the ideas for taking advantage of this type of market condition. With that, thank you so much. I hope you guys have a great trading day. And I'll see you guys here next week on our next Tuesday morning session. And again, I apologize for the 3-minute late start that we had here today due to technical difficulties. Thank you so much and have a great trading day.